Hi, I'm Giovanni Betancourt, trader and educator for Vantage Markets. Let's begin this conversation with one of my favorite go-to trading jokes. The market has one job, to screw each and every one of us every single day. That always gets a good laugh, because it sure as hell seems very true. The pain trade, as many call it, what could markets do that will inflict the most pain for the most investors? Right now, I think it's pretty simple. A slowdown in the economy that causes corporate earnings to diminish for a prolonged period of time. Call me Captain Obvious, but actually, I don't think it's all that obvious. It would probably require a dramatic debunking of one of the market's most powerful narratives. For years, traders have assumed that lower treasury bond yields mean higher stock prices and vice versa. It doesn't have to be that way, and it isn't the case historically, but it's been working pretty well lately. In the past 8 months, bonds finally started selling off too hard, too fast, and we got a real bear market. And now, in the past month, we've gotten the first decent bear market rally as yields have fallen. Heading into the Federal Reserve's meeting today, bulls are spinning the narrative that a slowdown in the economy will force Powell and company to dial down the hawkishness. We should keep yields contained and allow stock valuations to reflate. Getting the first part, yields down, but not the second, stocks up, will be the pain trade. Inflation is still far above the Fed's tolerance levels. We shouldn't expect it to go back down, a scenario in which the economy is indeed ailing enough to warrant a pivot from the Fed is the worst case situation and will probably be the setup for a brutal new leg of the bear market. We may be seeing the yield stocks narrative breaking down already due to the onset of a recession. Bonds have been rallying since some very weak economic data in the form of jobless claims and manufacturing PMI last week, but stocks are back under pressure anyway. If the 10-year yield drops below 2.7%, it will mark the end of this year's uptrend in yields. It's not something anyone should root for when the 10-year 3 month yield curve is in total freefall. At this point, higher yields should be welcomed by investors, at least in the intermediate term. But all habits die hard, and a lot of investors will likely be screwed if bonds rally after cautious Fed but stocks fell off anyway. With that, let's take a look at what markets could do at the open. There is a way that technical analysts claim that they can predict the movement of the following week. So let's say, for example, on Friday, the markets closed on a downbeat, and on Monday they opened on a downbeat. So if the markets close on Friday on a downbeat and they open on a downbeat on Monday, the technical analysis presumptions means that we will have a down week. And if you go back the previous week, you will see that the previous Friday markets closed higher, and on that Monday or the previous Monday, it opened up higher, and we had a high week. So now we are in what I call a lateral range on the market at this moment. Should we open? When we open, we could probably see a nice pop looking towards the our resistance level. Now we have a pivot. The market is trading right on that. We have our 50 moving average, exponential moving average, acting as a resistance, a dynamic resistance. So the market first needs to break that resistance in order to come and look for new highs. Let's take a look at what crude oil can do. Today is the inventories for crude oil, and obviously that will make some volatility into the markets. We have the 50 moving average, exponential moving average, also trading right across our pivot, and that could show a level of resistance, of strong resistance. Should we break that resistance, obviously we will be looking to come back up above the 100 level. Natural gas, after the news that Putin will obviously reduce flow in the Nord Stream 1 gas network, we saw a nice pop to the upside, and then a good correction. Now the market is trading right above our pivot. We've seen a nice uptrend line on Nat Gas, and we can consider that Nat Gas will continue to be in high demand due to the situation, and that the supply is minimum. So we could probably see a continuation of higher prices. All right. So let's take a look at gold. Gold, the same scenario, trading, uh, on a lateral ranging scenario, consolidation, you may call it. Our pivot is acting as a resistance. Right now, we are crossing our 50-day moving average as a support. Should we close below our level, our moving average, we could continue to see a move to the $1,700 level. Okay, copper has been making new higher highs. Now we are looking for it to recover, come back to up to the 345 mark. So 350 is a resistance. Take a look at that. Let's look at Bitcoin. Bitcoin, a lot of regulations coming in the United States. Coinbase taking a beating right now. So I will assume that Bitcoin will continue to stay in consolidations. ARK Investments has sold off on their Coinbase investments. They are under investigation by the SEC. So that could probably bring some pain into Bitcoin, probably a movement towards the 21,000 level. We have two channels to be trading here. One that the higher resistance of 22,000. Obviously, the 21,000 is the support, and one of 21,000 and 20,000 should we break our support of 21,000. And then we have obviously euro also in consolidation stage, as we receive more news of the market. Market has opened just now, so we should see some movement. Let's take a look at what the market could do at the open. A movement to the upside could be seen. Let's take a look at 30 minutes. We could see more movement in here. In 30 minutes, we can see that our moving averages are in the 20. So a movement to the upside is expected. 12,400 in the short term can be contemplated. Well, that's it for right now. Thank you for watching, and I hope to see you soon. Bye now.